Hi there, my name's Jay Bhatti. I'm a Senior R&D Tax Manager at MHA. Joining me today is my colleague, Lee.
I'm Lee Pimlett, the Senior R&D Tax Manager for MHA.
Following the Chancellor's Autumn Statement 2023, some further updates were announced to the R&D schemes in the UK. Before diving into the details of this and understanding the impact of what this means for UK PLC, it's important to look at an overview of all the changes. So the traditional schemes, if you like, where the SME scheme offered a 130% enhancement rate of qualifying spend, effectively resulted in highly loss-making startups, for example, realizing a benefit rate of 33p to the pound, whereas alternatively in the RDEC scheme, R&D Expenditure Credit Scheme, RDEC, the benefit rate was a flat 13%. The benefit rate was slashed in the SME scheme following the autumn 22 budget. So it went down from 130% to 86% enhancement rate. And what that meant in effective numbers for highly loss-making SMEs is they went from 33p to the pound to 19p to the pound, which is quite a drop. Conversely, the RDEC rate went up from 13 to 20%. So that created sort of an interim, RDEC SME scheme. The reason we call it interim is because we always knew HMRC had the intention, the government had the intention of merging these schemes together. And that's what was announced in the Chancellor's Autumn 23 budget recently. And what that entails is that the RDEC scheme will become the standard for most claimants. So it'll be at the 20% benefit rate. But a new special category has been created, which is called SME Intensive Scheme. And in order to qualify for that, at least 30% of your overall spend must relate to R&D. In addition to that, the other change that has been announced, that has been realized this year, is the introduction of the additional information form. So traditionally, claims were updated into a tax return and submitted. Now, the claim information must be updated into the AIF, the additional information form, and that must be submitted, and then the tax return submitted with the claim expenditure as well. Many people don't know about this, which results in automatic rejection, etc. So we are raising awareness. And Lee, we were talking about some of the nuances of the creation of this future scheme. And you had some interesting thoughts on how this would impact UK PLC.
Speaking from both my HMRC background and practice background, I think new RDEC scheme will be welcomed as it will essentially, firstly, speed up the preparation process as it'll become part of the accounting's treatment and preparation, as well as removing some of the over-egged claims, which have been submitted and sometimes last minute by less. How do we put this? Less
people with a less robust review process. Put it that way.
With a less robust system is the one we're looking for. It will also allow companies to claim other subsidies alongside of other state aid for the same development. On the flip side, it becomes very focused on larger companies, and smaller companies are going to miss out on a big fall in the value of the claim, as Jay has explained. Also, the new AIF will stop a lot of smaller claimants preparing their own claims on the basis that they will not have the systems in place to enable them to submit the AIF forms before they submit the final tax return. As Jay said, they maybe come to a point where we have a two-tier R&D system.
Yeah, absolutely. We were going into the whole intention of creating a unified scheme was to reduce the complexity so more people can claim confidently, and we do appreciate the AIF because it creates more of a review and requires more information to be uploaded. So it's welcome, but it does act as a barrier for as Lee said, for smaller companies, and you know we were pretending to be a startup. You know, what if you're a startup and in engineering compared to a startup in the tech or biomed industry? The tech and biomed industries would meet the 30% threshold for qualifying for the SME intensive category quite easily. But in engineering or manufacturing or food, sector-based SME may not, because they have other costs involved that may not be R&D based. But they could still be doing intensive R&D activities. That's the first point. And the second point is, as you said, Lee, you know, if you game it in your mind, there's nothing stopping. It's almost like the new system creates more inequality, because now you've got this exclusive club of tech firms that will be able to claim a much higher rate of relief. And basically the merge scheme is for everyone else. And as soon as those tech firms become profitable, because the UK has become a high tax environment, you know, unlike the old SME scheme that still provided profitable SMEs with a large benefit, there's nothing stopping them from leaving. You know what I mean? It's to protect their revenues, etc. Thank you so much for your time in hearing our insights into the changes in the UK R&D scheme and the resultant impacts that we may see. If you need any more information, please feel free to go to the MHA website. The next key update that we are expecting in the R&D world is upcoming to the spring 2024 budget. Thank you.